One and only Cody Davis. Good morning, man.
Good morning.
Yeah, a lot of stuff going on for you, right? I think there was an event you were at helping out, but you had two videos that came out last week. I think both very interesting that we can dig into. But do you want to talk about the event real quick, maybe? What it was about?
Yeah, it was a Creative Finance Summit. It wasn't mine, I was just speaking. I talked about how I structured a lot of my debt products in the past, how I look at debt, how I look at equity, and most importantly, cash flow. So it was fun, but it was at the resort that I used to own that I am no longer a part of, and my buddy still owns it.
Very cool. And I think some people in the school community got to actually meet you in person, so that must have been fun. But yeah, like I said, two videos every week, so I love it. The one that really caught my eye was the one talking about kind of setting yourself apart in, business and whatnot. So where did that one come from for you?
Well, I put that video online when I was putting up my Christmas lights. I was hanging lights. It's something I started doing last year. It's just the little extra effort that goes a lot longer than the effort you put into it. And so last year I hung eye hooks around the roof line of my property, and it's a property that I've owned for almost 6 years now. It was the second 12-plex I ever bought. So I decided to line the roof with the eye hooks and then hang the lights. And it takes a year to set it up and a year to take it down every year. But the residents really like it, and so I continued doing it. And the video was just talking about finding the little things in your industry that go a long way, because not everything has to be busy all the time, tons of effort. There's periods of time where it has to be a lot of effort, but sometimes the smaller things go farther than the big things.
Yeah, I'll put it out there real quick because Jovi is just tuning in to make troubles because his Packers beat the Bears yesterday. Tough game, but we'll get you in 2 weeks, Joe. So I'll put an end to that. But yeah, that video really, like I said, it's people don't think about the small things like that, from a business side. Is there other things that you do? Because I do see a lot of people like in the community always asking about like, do you send gifts to their tenants during the holiday season, like gift cards, things like that? Is there anything else that you do from that side?
Yeah, I've done some gifts before. I've done cards. I've done like baked goods, which probably shouldn't. Now I wouldn't do that. I mean, that'd be so many uh, Safeway muffins, 130 tenants, or 130 rentals, I should say. And so just little things here and there. And it depends. Like, I haven't done that on every property, but do it where you can.
Well, to that point then, so is there like, do you like rotate or how do you decide what property, I guess maybe you're going to do that for?
Well, it's an easier decision if I own it by myself. If I have with a partner and that LLC has just been abused that year, is how I would put it. It's been financially punished. Then they may not be in the mood to want to do that, and if it doesn't have the extra few $100s or $1,000 or whatever it costs to get everybody something, then it doesn't happen. It just depends.
Do you think landlords like underestimate like how powerful these small gestures can be?
Yeah, because to them they're thinking, oh, who cares? It's a $10 gift card. Like, that's not going to matter when they pay me 1,500 a month, but it's not owed. The 1,500 would be owed. It's a it's just extra. It's something that almost no one else is going to do. So if you're not expecting it and you get it, it can make the holiday season pretty fun.
I do see Alex, the accidental investor, tuning in from your channel. Yeah, so you guys got to meet in person at the event we mentioned a little bit earlier. So that was super cool. I know Alex is a big part of the community, and he just posted something in school about networking and finally getting to meet people. I think you also mentioned Millennial Mike may have been speaking at this event.
Yeah, he was there. It was cool to see him. It's been probably a year. I don't think I've seen him since the last event. So
Lot has changed since then, right? I think you got married. He has another child, right? So a lot has changed since the last event in Vegas. But how do you decide maybe like what are the little things that you do? I know you said you're putting up the lights already, so you're recording, but like how do you decide on what you're gonna do? I guess.
You just have to pick something. It could be a gift card to everybody. If you get a $10 gift card for a 12plex, it's $120. Like that, but it goes a long way for some of those people. Or if you want to go a little bit bigger, you could do $25. Now you spend $300. Oh no, yeah, is that what it is? Yeah, that is what it is. Still waking up. So it's like you can allocate whatever you can in your budget to doing it. And if you have a property like a duplex, maybe you're only cash flowing $300 a month, if that's the number, then maybe you get them a $50 gift card because you can afford to give 100 of the 300 this month, whatever it may be. You just got to decide. It's not going to suit everybody. You can't make everyone happy. We've seen that. You look online, you're going to see someone does one thing, no one's happy, and then they do the other thing, and then they're still not happy. It's like someone's going to find a reason to complain either way, so might as well pick something.
And I guess one of the big questions someone would probably ask you is, have you noticed a measurable difference in like retention for these tenants?
The tenants that I work with and do little things for stay with me the longest, for sure. I've got tenants that haven't left since I bought it, and I've made sure that they feel heard, that they get little things along the way, and they don't leave. And why would they? Unless they were buying a house. I just had a tenant who was living at a place for 6 years, and they just bought a house. They went from a 500 square foot dated apartment that it was dated before I bought it because they were living there before I got it. And they just bought a house. I'm like, that must feel nice. So that's a good reason to move.
Well, people that are tuning in, I see like Big Val tuning in, Kenny. Anyone else watching? If you guys do anything for your tenants, put it in the chat so we can kind of find out what other people are doing. Has any of your tenants reached back on and said like thank you or anything?
Yeah, they have. And some of them have gifted me things too over the years. So that's cool.
Do you think like as your portfolio grows though, is it going to be harder for you to kind of like stay connected with these individuals maybe in a sense?
Well, with these individuals, the only way it would be hard to stay connected is if I sold the building. With moving forward, I don't see a way to have the same level of connection with all those tenants. As an example, so one of my goals is to build to legacy property. And I believe legacy properties have a net operating income, a cash flow if you had no debt of $500,000 a year or more. So if you had it where half that was going to debt, a family could live off of it, even if half of that income was going to debt payments. And if it was paid off, you could be very giving with the money too. Like you could donate a lot, live, and not really worry about the day to day. So I don't see a way when my target is to own properties like that, multiple, to know all the tenants, to understand all of what they're going through. My goal is still going to be to run the best ship I can with those buildings, but it won't be as intimate of a relationship with the building as it is right now. I just don't know how I would do that because I haven't done it yet. There may be 2 years down the road when I have like a 75 unit or a 50 unit new construction and I have a better answer for you, but I can only speak from my experience.
Let's see. Do you see these as community building touches as a business strategy or more like personal pride thing for you?
Both. You should be proud of the assets you hold. That's the bottom line. It shouldn't just be about money. Also, on a 12plex that I bought, I added a patio, outdoor seating, I added a laundry room. If I were living there, I would be more likely to renew if I had things like that, opposed to if I didn't. And so while, yeah, it makes the building look nicer and it makes me more of a proud owner, it'll never be Class A because of the year it was built, the style that it was built in. But if it's the difference between a slummy Class C building and pride of ownership Class C building, I'm going to take the pride of ownership one because there's going to be a tenant for that type of inventory no matter what. And they might as well have the little things. Because before it was just rockscaped outside. It was that lava rock. made it more of a industrial feel for Moses Lake, and so cleaned it up, put in patios, put in seating, and it did go a long way, and it wasn't that much money.
Has any tenant ever maybe complained about something you've done for them? Like if you've, like you said, if you did baked goods or gave them a gift card, like, they don't shop there or something. Like, have they ever kind of complained to you, like, hey, can I get a different gift card or something?
No.
Yeah. That's always my concern. It's so hard to please everyone out there, I guess, right? So,
Yeah, I would just say, hey, if you don't like it, find someone who really needs it and give it to them.
yeah, good response. Yeah.
If you don't need it enough to use it, then find someone who is less fortunate.
Now, your other video for the week too, you're talking about if you never cash out refinance, right? Is that correct?
Yeah, what would have happened if I never did a cash out refi? That would have looked different.
Yeah, I mean, dig into that one because that one had a lot of good amount of viewership and interaction on that one also. So what was on the top of your mind on thinking about that one?
Every once in a while, I look at my portfolio and the mistakes that I've made. Cash out refi was not one of the mistakes. However, it's important to review what would have happened if you made the decisions you made versus if you hadn't. And what would have happened if I hadn't done a cash out refi? I probably would own my sixplex today in cash. I since sold it, flipped it into something else. I would only owe, and this is just based off the amortization, I would owe about $1,450,000 on my 39 unit. Today I owe 2.49 million, basically $1 million more. But the money I pulled out allowed me to make it worth about $1 million more than it would have been. So I basically would have had less debt exposure, similar cash flow today. So my risk adjusted return would be better. The only difference is I would have owned slums, not the quality of stuff I own today. So it would have been at the expense of my tenants. I would have been richer. But that's just looking at it as short term. Long term, as long as I can hold on, I'm going to be significantly wealthier because of pulling out money, reinvesting it strategically, upgrading the buildings, getting rid of the capital expenditures that come up. Like this week, I'm doing another 2 units I have to replumb and do new showers, and that'll be expensive. But some of that money came from a cash out refi. So I have a better portfolio today, but I had a better risk adjusted return had I not pulled the money out and just kept. I probably would have owned 70 or 80 rentals at much lower leverage.
Flavio has a question kind of on the original discussion we had. Where is your limit between you and a tenant? I don't want to be friends with my tenant.
Well, I think you found your limit. Keep it business. I mean, I'll joke around with tenants, but I also own a small business. Like it's not as regimented as a big business. If I had hundreds and hundreds of rentals, then I would have to do it a little differently. But like my tenant say, hey, are you raising your rent or raising my rent? I'm like, yeah, I'm just adding a zero. Don't worry. I'm just putting a zero on the end of your rent number. Nothing crazy. And stuff like that. But we have that working relationship. I'm not going to go hang out with them. Never do. Like you don't want to do that. There has to be that separation. But it doesn't have to be cold, dry business either. That's how you get more turnover.
I'm not sure if you, so have you ever done like how Dion, I'm not sure if, so they know you're the owner, I'm assuming then, like, or do you kind of try to make like you're like a property manager, or like Dion says, like, oh, I have to talk to my partner, and my partner can be like the dog, or it can be the, or it's just like he has to ask someone else when there's a decision to be made, right?
Yeah, I wanted it to be that way in the beginning, but I have tenants who watch my YouTube, and so some of them might see this, and that's fine. That's why I position things the way that I do. You just tell the truth. You don't have to remember what you said, but I I own most of my stuff without partners, and a lot of my tenants, they know that. So, I mean, I used to position it as I am the property manager, but then communities are communities. You start to become brought up more and more, and you show up more places more consistently, and people put two and two together, and it's like, all right, I'm not even going to try and hide it anymore because it's not. You can't do it.
Yeah, I think that even with the whole, I mean, not legal advice, but the whole LLC entity structure, right? It's kind of the same thing, right? You can, when you initially set it up, it seems fine, but then all as you keep progressing and adding new things and doing new things, it just makes it so much more complicated. Like you're saying, to try to make like your anonymity type of thing, or you're the property manager and stuff like that. So, was there a moment where you regretted pulling equity out?
I couldn't be where I'm at today unless I did what I did. So I can't. I don't regret it. But I do look back and wonder if I could have found another way to find the money. Water flows to wherever is easiest, and so the easiest way for me was to pull out money. But it just makes me wonder, was there another deal? Was there a deal I could have bought, flipped, sold? Was there another brokerage deal I could have done just to get enough cash together to do what I needed to do? Had I not pulled money out of my 12 unit in Moses Lake, today I would owe a little under $500,000. Today I owe 973. I did a lot of scaling with that. I bought a 10 unit, a duplex, a 15 unit, some other stuff. Happy I did it. But the pain points I've had to go through are a result of pulling those out. So I got to basically go in the fast lane for learning a whole bunch of lessons. I wouldn't have known those lessons had I not done it. So I can't regret it.
I see Brandon tuning in. He has a management company in Texas, but he's my Tuesday regular guest and who's also going to be speaking in Vegas. But he says, they know I am the owner, but still keep some distance. They are the customer of my business. Let's see. What was my next question? Yeah. What do you say to investors who are terrified of cash out refi risk and prefer to keep properties debt light?
Well, it just goes back to your goal, because if your goal is to be debt light, then why would you? Something that's important to note is, will this step move me closer or further away from my goals? Because making a change in your business is rarely going to keep it identically the same. When I go make a decision today, is it going to move me closer or further away from my goals? And one way it could move me closer is separating from a business partner and owning it by myself. That is a huge step in the right direction. I believe that for most people's situations, that can be the right decision, to own a bulk of your portfolio by yourself. But again, it comes down to what you want. If you want less debt for whatever reason, doesn't matter. You could be debt averse. You could think that all debt adds more risk. There's times where more debt creates a less risky situation than where you are right now. An example, let's say you have $1 million of debt at 7%, and you could refinance that, which is going to be an $80,000 a year payment if it's amortized over 30 years. You could refinance that to $1.2 million at 6%, amortized over the same amount. You're going to have about $86,000 a year in payment. Your cash flow will go down a little bit. However, your disposable liquidity will go up. And if that just goes into reserves or a money market account, your sleep at night fund, that could reduce your stress level. So figure out what you want. If I had the opportunity to pull out more liquidity and have my assets cover it and just put that sleep at night money, right now I would.
I see Gus, who's a new member in school. He joined about a week and a half ago. He is saying, most time I think about it is about paying down the principal or expanding and creating more opportunity as long as you're underwriting correctly. I'd rather have a bunch of assets with good debt. I guess Curtis is working. I was going to see if he wanted to jump on right now, but he says, I have a seller interested in selling me 20 units that are free and clear. Cody, what's the best way to contact you to discuss it?
Yeah, I mean my phone number's all over the internet, so I might as well put it here. Do you want to type in the chat? I don't think I can from my. Oh,
Well,
maybe I can go on my phone.
yeah, or if you, yeah, I can type. I mean, or in a private chat. Let's see. Flavio says, Cody, where is the area that you have to wear a bulletproof vest in Moses North?
That is located. It'll show up on a map. It's called the base. And back to Gus's
Oops.
discussion, because I do think that's a good point that we don't want to just gloss over. The idea of paying down more principal. Again, it comes down to your goals, but you have to look at it analytically and say, am I going to make more long term wealth from paying down principal in this market, or am I going to make more long term wealth from getting into a deal potentially with long term interest only to maximize cash flow and let the appreciation do the building? Because over a 10-15 year period, you should, as long as you're not buying in a dead market, have equity built into your portfolio. The question is, can you wait long enough to get there? So what I have been doing I don't have a whole lot of residential stuff, but on the few residential properties I have, what I do is I lever those up with interest only debt. It's 10-year interest only, 30-year AM. I've been working with a gentleman at Coast to Coast Mortgage for that. And it allows me to maximize my cash flow, maintain control of the asset, and just be in a better financial position while I wait for it to go up in value in those markets, because those markets are growing, they're not contracting.
And then so back to Curtis's question real quick. I'm not sure if this is the same individual, but I know he had a sit down with someone before that had a lot of paid off properties. And I'm not sure, Cody, if you ever thought about this or what. So this individual, I think, might have been 20 or 30 paid off units, but they basically don't even have insurance on their properties. They just put aside money almost like an insurance policy for themselves because they feel like insurance, got to jump through hoops. They may not pay out, all these type of things. So they almost building their own insurance policies on the side from the cash flow. Is that something you ever thought about?
I wouldn't do that. I've heard of some people that do that. If you can self-insure, at least I don't think you can self-insure at a comfortable level on a small scale. Like if you have 20 units, let's say your net operating income is 12 grand a year per unit, got $250,000. If you want to live your life on $250,000, you could do it, especially if you don't have a home loan. But you have a building burned down, you're not rebuilding it on $250,000 a year. I mean, I don't see it unless you're not going to live on any of that money. Like you might be able to rebuild a house in some markets for that, but you're going to go back into debt. I'd rather just pay the money for the insurance. It's not an investment product. It's an insurance product. It's an in case, and hopefully you never have to deal with it. And that money's just set on a table and lit on fire, but you get the idea. It's there in case you have something catastrophic. And I sleep well at night knowing I spend a lot of money on insurance. Sure, I wish I had it in my pocket, but that's operating off the assumption that that thing's going to happen, because I'm not going to claim anything unless it's catastrophic.
Ike is in Kansas. He's a firefighter in Kansas, but he bought his tickets. He joined us the other week, couple weeks, but he did buy his tickets for the ORAD event, Cody. So he will be there.
Sweet.
But he is asking, how much are you planning on gambling in Vegas to pay for your trip? Yes, from Hawaii, it's a little bit pricier than some areas, but I do not gamble at all anymore. So Vegas, there's a few people that sit at the tables. I would say most of the people kind of just hanging out, talking story. Some guys go out after, so maybe the night ends around 2 o'clock. And there's others that go out, and that's when they gamble for a few hours. But yeah, I wouldn't say too many people were gambling the past 2 years. Brandon is here. B2R investing. Yeah. Let's see. Huh. Ooh, okay. I think this is the question that a lot of people are facing in the community right now. They're in that kind of um not in the early phases and not in the financial freedom part, the end part. But how do you balance growth hunger with safety when pulling out equity?
It's going to depend on the property type you're building a portfolio. Let's go with another example. Let's say all of your properties are duplexes. You own 20, we're going to say Mark owns 20 units and Cody owns 20 units. Mark's units are all duplexes. So you have 10 properties and I have two 10plexes. In your situation, if we both want to, let's say, go from 20 units to 40 units, I would feel more comfortable levering up duplexes to 80%, getting interest only for 10 years and then 30 RAM after that. Then I'd feel comfortable levering up my 10plexes, because my 10plexes, if I have NOI hit for insurance going up, taxes going up, rents potentially going down for a little bit, getting cash crunched, I'm susceptible to getting my loan called and not being able to service the debt and being forced to sell it by my lender. You would not be. So I would be more inclined to go max leverage on smaller stuff, but maybe instead of levering up all 10 of your duplexes, lever up 3 to 4, 5. Look at it as a portfolio. And if you're levering up even 5 duplexes, 10 of your units, half your portfolio, and you go buy another deal low leverage, well, you didn't just increase your portfolio leverage a whole bunch, percentage wise, because you put a whole bunch of money down on the next deal. You got to look at your global cash flow, your global debt coverage, and take into account how many more maintenance time bombs that you've picked up. Because if you go buy another asset and it cash flows and hits all your metrics, but it has a whole bunch of CapEx that you're going to have to address, it doesn't matter if you hit your debt coverage, because CapEx isn't included in debt coverage. You got to make sure that you still have the reserves to go take on the next deal, and you're not just stripping your equity and then going down to minimum reserves. If you're going to do that, I would consider doing it on the residential stuff first, because you haven't probably been through the financial hurdles of the bigger properties yet with loans and the financial covenants, and then keep your reserves in excess of what you think you need, because when you go buy that next deal, you could have a whole bunch of stuff that goes wrong. I had a sewer line go wrong on a building I bought. I had to replace majority of the plumbing within the first year. Insurance told me I didn't have to replace the electrical panels, and then they got the policy in place and said, actually, you do. When I got it in writing that they said I didn't need it. And they said, well, you can cancel and go somewhere else. Great. So there's things that will pop up that have to be addressed, and just make sure you don't take on too many CapEx time bombs in relationship to the reserves you go into those deals with.
So that's also kind of your plan or maybe new strategy too, right? You're going into newer things, right? Newer construction, newer
Mm-hmm.
builds, right? So less capex. Is that going to impact maybe your thoughts on doing cash out refis down the road, or you're kind of content with keeping these newer properties and things?
I'll also do cash out refinances, but it's just a matter of when. Like it'll take some time to get it all done. And right now, my 7 unit, I don't have the leverage to pull out to where I'd feel comfortable, or at least I don't have the equity to pull out where I'd feel comfortable. So it's probably going to be 3 years, 4 years, maybe 5. Even if it's 10, doesn't matter. Cash flows, and I can set aside money for reserves. I am listing some of my older properties for sale, the 1031 into more new stuff. So that will delay my timeline for pulling cash out. But I'm going to get rid of some of those CapEx time bombs too.
So I did actually hear some people in school on some calls recently talking about they are looking at 1031s. Have you completed any 1031s
Mm-hmm.
already? So what
Yeah.
maybe pointers or things could you give them as far? So let's say you're attempting to do a 1031. Um, would you still continue if the 1031 wasn't an option? Like, let's say you found something you wanted, a 1031 wasn't gonna, would you still maybe pay the taxes just to complete the transaction to do another deal?
Yeah, I would. People focus so much on not paying taxes or getting the best deal. It's not about getting the best deal or paying the least in taxes. It's about using the resources that you have to go get what you want. And if that means you have to pay a little bit of taxes, or you don't get the best sales price, or you don't get the best purchase price, you do it. I did not get the best purchase price on my sevenplex. I paid 50,000 more than maybe anybody else would have. But who cares? I'm not buying this for someone else. I'm buying it for me. It gets me what I want. And if that's the price I got to pay to get in, so be it. But don't try and get a silver bullet where everything lines up. We've talked about that one before. You don't need everything to work. I paid a little more than I wanted to. I sold my 6 unit, the property I sold to go buy my new construction. I sold it for less than I would have wanted it to. If I still owned it today, it'd be worth over 100 grand more than I paid for it. But it is what it is. I didn't want to maximize my equity on that project. I wanted to go take the money and buy something new to show that I could do it. And now that I've proven it to myself, I'm going to likely do that where I sell stuff at probably 10% less than I would really want, but it'll allow me to go buy a bunch of brand new stuff where I go from 130 old units to probably 50 or 60 new units once it's done.
Yeah, Gus is saying 100%. I do see Dion tuning in from his trip. So he said every time you hit the like button, an angel gets its wings. So thanks, Dion, for stopping by. Brandon is asking though, do you think you would grow as fast as you did with the financial stress all over again, or slow it a little and have less financial stress?
I'd probably try and get it done. I'd rush through it. I have different pieces now than I did back then. Example, I have a wife with a W-2. That's helpful. I actually know a little bit about some of the stuff that I'm doing now. That's also helpful. I know how to structure seller finance notes. I know how to get bank loans, what they really want. I know how to get the DSCR loans if I don't want to go the conventional bank route. And so I have more pieces I can work with. If I were to do it again, though, what I would probably do is I'd go find a duplex to house hack or a fourplex to house hack. And I'd get into that type of deal because I have different pieces now with the W-2 helping out. And then I'd go do a few apartment deals and I'd pay off the house hack as quickly as possible. And I'd try and pay it off, whether it's a duplex or fourplex, whatever it is. My goal would be, how could I pay this off in 2 years? And once that's paid off, financially free again. Because I keep my cost of living right now around $4,000 a month. And between a paid off fourplex would get me that, and I wouldn't have my rent, so my cost of living would actually be less. It'd be closer to $2,500. I could be done. It wouldn't be like a huge retirement, but it'd be a 2 to 4 year window to financial freedom because I know what I know now. So I'd try and grind it out. And while I don't wish that upon anybody, especially not myself, that would still get me to financially free by 30.
Nice. Yeah, and people don't realize like Dion does not have a huge portfolio unit count wise at all, and he seems to be doing very very well for himself. He's in Thailand right now for probably what 3 months. I bet he's going straight to Vegas to the ORAD event from his trip. So it doesn't take a lot of units, right? Sometimes and I think people overlook that fact.
Mm-hmm.
Let's see. Ooh. Um. What's more dangerous? I know it's kind of, but never refinancing or refinancing too often.
Dangerous relative to what? I mean, if your goal is to grow quickly, then never refinancing would be dangerous in relationship to that goal. If you are afraid of going bust, then refinancing too often is not going to be the move for you. It's all relative.
Yeah.
It has to be relative.
Yeah, I think that's the one thing a lot of people do struggle with, right? They have everything in a box, right? And then that's how they're uh doing their investment. It's like it's all, it has to fit in this box for it to work, and they're not kind of stepping back and seeing the whole big picture of things.
Hmm.
Hey, Grumpy Contractor has tuned stopped by. Morning, man. I hope I think he's wrapping up his two birds, three birds. I know he had go. Maybe one was completed. I know he's wrapping a few up in California. Hopefully, he gets that all done soon and can take it easy for a little while. Yeah, I don't know. I mean, what anything else you wanna discuss on this topic, or even back to the original one about you, setting yourself apart in business? That's just the small things.
Just keep it simple. Uh, if you can find the thing that other people aren't doing and it makes sense, go do it. It doesn't take you forever to get yourself set up, being known as someone who operates differently than the rest of the folks in town. So I would just keep it as simple as you can, and whatever works with you, keep doing it. And on the debt thing, if you don't feel comfortable with it, Dion just did a good video on this PTSD versus PTS. I liked that a lot. You can go watch that video. That was on the One Rental at a Time channel.
Yeah,
But it's
yeah,
good to get
makes you
that
think,
takeaway.
man.
Yeah, he does.
You're funny. Wait, hold on. What do you say? You're funny. Take. Oh, yeah. Jim doesn't know how to take it easy. That's why him and Yasik are always butting heads in the calls, on in the school community calls. Oh, Charles has a question for you. Cody, when would you buy stocks and bonds?
I would buy stocks and bonds when money doesn't matter. It's not my strategy right now. I'll just throw money into the S&P 500 when I can. And of course, could figure out how to do it now. And of course, I could throw some money in it now, but money still matters. And by money not mattering, I don't mean like I don't need it anymore. It means there would be so much that I can't spend it. And so, like at that point, yeah, buy some gold and buy silver and buy stocks and mutual funds. But if you want to go efficiently, you have to be very focused. And right now, I have some more goals I need to hit in the relatively near future. So next 18 to 24 months, there's things that I have to do, as everybody does. Everybody's got something. If I hit those goals, then I'll probably start buying into that stuff. But I don't think it would be responsible to do that right now.
Yeah, it's so hard to put it into other things when, like you're saying, you have these goals that you want to do, or these projects you're working on. Everything's pretty much funneling to these other projects that you're working on.
Yeah. And I know if I diverted a little bit of money every month into something like that, it like I wouldn't die. But there's something about being, as Dave Ramsey would say, gazelle intense. Focus on the target until you completed the target, and live like no one else, so that later you can live and give like no one else. That's the idea I've got with it all.
So I think Charles is referring to Coach Carson. He says Coach has moved some money, so he was just curious. And I think to that point, right, like Coach Carson kind of has, he's at the end game, or the final stages for himself as far as maybe what he's trying to do portfolio wise, and he is just trying to preserve some wealth maybe and putting it in other asset classes. But I think he's hit his real estate goals in a sense, and now he's just in the next endeavor. Like I think he was looking at new builds and new construction, and but I think as far as his main foundation, he's pretty much set there, and now he's just trying to allocate it in other areas.
Yeah. And once I get to where I want to go, and I'd like to be at 70 new townhomes in the next 24 months. That's that's not where I stop in real estate, nowhere close, but that is a place of more cash flow than I could spend. And those are very expensive. So a lot of my resources have to be allocated to that, because right on today's dollar, it's 237,000 a unit. So it's like I'm not buying $50,000 units anymore.
Yeah, it's all relative, right? So like you're saying, compared to what, or like Jason Hartman likes to say, right? Compared to what, right? So let's see. Well, maybe wrap things up. My son has JPO again. I keep forgetting. It's every so many weeks, so I gotta get him up soon. Let's see. Ooh, in hindsight, do you think you pulled equity at the right times, or would you time them differently today? I know it's hard to probably say, but looking back.
Consistently, I've been tested on this, and we'll see if it continues. When I've needed money, I've gotten it. There's been times where I thought I really needed it and it didn't come in. And then I was like, another couple weeks would go by. I really need it to come in. It doesn't come in. And it's tested me in a way that I've had to figure out new solutions. And by the time that I ran out of solutions, I finally got the refi to hit and it solved my problems. So I don't know what you call that, but every time I've really needed it to come through, like actually needed it and ran out of solutions and couldn't creatively figure out the situation any further, I've gotten the refinance done. And there have been situations where I thought I needed it and I learned a lot of stuff about myself in the process of not getting it. So, yeah, I wouldn't change any of it though. Because if those refinances had happened when I thought I needed it, I wouldn't have learned the lessons that I learned.
The accidental landlord, he may probably hit you up in school. I know he's working on a seller finance deal right now. So he was on one of the calls this morning in school, and he is working on a seller finance. So he may shoot you a message.
Cool.
But he says that would be an awesome problem. More cash than can spend. Flavio wants to know, how does your week look like as a landlord, building from scratch, real estate agent, etc. So what does Cody Davis's week look like? So today's Monday. So how does your rest of your week look like, you think?
I am walking a few commercial buildings with the property owner today that I might buy. That'd be my first strictly commercial property set. We're also chatting about some eightplexes. So looking into that, some owner financeable opportunities there. I'm meeting up with a, a bank. They're driving in from Wenatchee tomorrow, so we're gonna grab lunch, tour the portfolio, and discuss some opportunities to start working together. I'm meeting up with the CEO of another bank on Wednesday. We're going to be discussing some development loans. And I do my videos every week. I'm going to be walking some of the properties for renovation updates, checking out what needs to be done. And I mean, that's pretty normal. We do a real estate brokerage meeting on Tuesdays, but I mean, there's nothing crazy. I coach gymnastics 3 times a week, 3 different days, so it's
No,
fun.
touch on that real quick, like the YouTube side, putting out your videos. So like, maybe people look at you and say, "Oh, Cody's well established already." So, for him putting out videos is beneficial to others. But like people that are getting started in a sense, would you say it's helpful to document your journey, and has it helped you make connections and deals or connect with people out there?
For sure. Some of my first bank loans were heavily influenced by my online presence. The bank could see, even though I'd gone fast, there's something that I learned. If you build really quickly, banks don't typically like that because it's very hard to conventionally build from nothing to something that quickly. So documenting what I did was nice. It's not like the bank itself can watch the videos, but the reps can, and they can get an understanding for the business and what I went through and how it came to be. So I'd recommend putting yourself out there. And I don't script my stuff, never have. My presentation at the Robinhood, I didn't script that. And the only presentation I'll ever script is the one for Zuber. But other than that, I would just put out videos, whatever's coming to mind that day. Do that for yourself, whether you feel like you're established or not. Because I was putting videos out well before I was established on the original channel, the multifamily strategy page. You scroll to the oldest videos, it was just me in someone's office building posting videos. That
And I
was it.
think I think you said in the beginning too, right? That you would actually try to like it has to that you would record yourself a few times, start over. But now it seems like you said, you're just not scripted, just recorded and you put it out there, right?
Yeah, the only time I've recently had to re-record, my phone ran out of storage. I had to delete a lot of videos.
That's right. Yeah, well, like I said, I gotta get my son up. This was a good short one today. I love doing these on Mondays, recapping your videos. I think a lot of people get a lot of great information out of it. And like you said, if people want to see Cody's only scripted presentation, they need to come to Vegas for the One Rental at a Time event in February. And you actually see what kind of presentation he'll put out there for everyone, right? So, are you almost finished with that, or not even started yet?
I've started, but it's not finished. It's either going to be really good or really bad. A lot of my presentations go well, but I've never done a scripted presentation before. So when you don't have a script, you can't derail it. It is the script. I'm going to have to be very intentional not to derail my script.
Right, well, you have some, you're kicking it off, so the event is focused on you kicking it off on Saturday, right? You're the day one speaker, right?
We'll make it happen.
All right, cool. Yeah, I'll see you at the Gen Z call on Saturday, and I'll see you next Monday. So everyone, thanks for tuning in, and I'll be back tomorrow with Brandon Potts, B2R Investing. So thanks, everyone. Have a good rest
All
of the
right.
day.
See ya.